Welcome to the Live Squawk podcast, where professional traders, investors and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out Live Squawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required.
Hello and welcome to Live Squawk's Market Talk, our weekly review on Monday, the 1st of June, 2026. This is our weekly briefing, which aims to break down the key stories from the past 7 days and explore the subsequent implications for the markets. We'll also take a look at what's ahead, giving you a heads up on the events and data points to watch out for. Listen in on our take of what to focus on for the week ahead. I'm joined today by Nussbaumer, founder and CEO of Macro Beat. He's an FX macro trader, researcher, and FX tutor, and a market professional for now nearly 40 years. And he'll be helping us just try and sift the news and the important stuff from the chaff, really, the wheat from the chaff. Before we do that, though, just a quick piece of housekeeping. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional for making any investment decisions. Investing and trading in financial markets carries a risk, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. And with that, just a quick look at what we've got on Monday today. As I said, the 1st of June, start of the meteorological summer across the Northern Hemisphere. And really, it's as you were, really. We've got this war now going into its 13th, war. We've got this dispute, crisis in the Middle East. It's gone on for its 13th week now, with no seeming resolution in sight, despite promises from the US President Donald Trump that a deal is around the corner, and constant refutes backing away from that assumption from Iranian leaders. So much so, we've had the same thing again over the weekend, where President Trump has already said that if a deal's not coming soon, he threatens if we don't get what we want, we're going to end it in a different way. He threatened. To their end, Iran's top negotiator, Mohammad Ghalibaf, Speaker of the Iranian parliament, said that Tehran would not agree to any deal with the US unless the country's rights were fully protected. And subsequently, we've had comments out today, as I said on Monday, that says in light of the continuation of the crimes of the Zionist regime in Lebanon, and the fact that Lebanon was one of the preconditions for the ceasefire, and that the ceasefire has now been violated on all fronts, including Lebanon, the Iranian negotiating team is suspending talks and exchange of texts through mediators, as came initially from Tasnim news service, Iranian news service. What we've had is over the weekend strikes and counter-strikes by the US and Iranian armed forces. That wasn't enough, apparently, to call an end to the truce, according to the US administration. But as you just heard, subsequently, the Iranians have had enough and have now pulled all mediation whatsoever. They sent oil up. Oil is up some 7% on the markets today. And I guess we could talk about what's happened last week, but there wasn't a material amount of news and information last week outside of the geopolitical situation. We do have, I think Kevin Walsh, he ended his first week as Fed chair. We'll have a look at that since we have an FOMC meeting coming up. But we also have other central bank decisions coming in the next fortnight or so that are quite telling. We could talk about that, but I think ECB is probably at the foremost of most people's minds in terms of what we'd like to see. We'll get into all that with Beat now. So, hello, how you doing, my man?
Hi, Harry. Not too bad. Thanks a lot. Thanks for having me.
That's all right.
And as you rightly said, there was nothing really to talk about last week, other than the usual Friday news about peace. which seems to be a regular thing on a Friday, just to be shattered earlier in the following week. I think you alluded to it. Obviously, the market is trading on a glass half full for weeks now, mainly on the basis of the view that neither Trump nor Iran actually want to go back to war. It seems that is quite obvious. It looks like Trump is desperately looking for that off-ramp and has to sort of try to balance, because the problem right now is that the deal that he would be striking is actually worse than the one he ripped up in 2018. So he has a bit of problems on all fronts. Now, what you mentioned, the ceasefire breaks last night, and there was a similar incident last week, didn't really cause any market reaction because the market just seems to think that something worse has to happen before actually it were to derail the talks. Now, that those talks may have just been derailed because for some reason or another, it seems that Trump lost control of Netanyahu, or some say, he gave him a hint that he has a few more days to achieve his targets before Trump would sign any deal. So there's a lot of conspiracy around going that in a few days' time, when Israel done whatever they've done, then Trump may be ready to sign some sort of a MOU, which we all know is just really kicking the can on the bigger issues that just cannot be solved on a weekly basis, really, which is the whole uranium stuff, nuclear stuff is all a very technical story, so that you don't solve that on a weekend. But long story short, the stop now from Iran on all the talks, like you pointed out, has just created quite a bit of a dollar rally. Oil just rallied 7%. So that is the first time that the market sort of started to get a little bit nervous that, until this moment, nothing seems to have derailed these sort of back channel talks back and forth. But Iran seems to be quite serious that any peace has to include Israel stopping the bombing in Lebanon. It's a very delicate issue to comment, but I think the whole world doesn't want to see a second Gaza, and I think that's why I think Iran speculates that they probably have more support out there than you might think in terms of what's going on in Lebanon, and that it should be part of a wider solution. So personally, I think we may have a bit of risk off today, maybe leaks into tomorrow, and then we're probably going to get a few more positive headlines. It's really about what we might talk during our session, the impact. Hormuz, obviously, a few more ships have passed, but it's still closed. So the longer this lasts, the bigger we said the impact is going to be on shortages on not just oil, but other goods. Price is definitely going to go up on all sorts of things. We talked about fertilizer last time. Those prices shoot through the roof. We have all the farmers already being in trouble in regards to that sort of food price increase, and the whole inflation goes. That is sort of as the knock-on of that. So my personal view is we're not going to go back to war, but I wonder how much longer we can just have Hormuz closed the way it is for not creating additional problems.
And again, this is we're looking at the impact on prices as we have done, but also on the degradation of demand and the effects we're going to have the longer this continues to roil on. And it's as I said, we're in, I think I've got it right, in our 13th week. So again, these effects are going to be becoming more embedded as we go along. That you get into the economics of all that, but just in terms of how that affects your trading and the way you think of things at the moment. We've been over this a number of times, and in the early days of this conflict, it was always, you play the shorthand. You want to play what's in front of you right here and now. Don't get too deep into things. Don't put too much on because things change very swiftly. Again, 2-3 months on now, that situation hasn't really changed. So is there any gearing that changes on that front?
No,
or is this now simply just same
story?
Yeah,
the only interesting part maybe has been that we had this sort of RBA story, Aussie story early in the year where the Aussie started to rally on the hawkish RBA, blah blah blah. And then suddenly we get like weaker CPI, weaker job data. Suddenly we have like we have, let's say, in the periphery, we have some interesting trades where the Aussie suddenly started to underperform. We have a major peak in Aussie Kiwi after a very long rally, but these are all nothing to do with macro, or let's say the broader macro. That's just the sort of niche stuff where the only places where you can go is anything that is not directly linked with the war or directly linked with the dollar. So we've gone from a divergence between the RBA and the RBNZ to something like a convergence where we have like RBA hikes slowing down, or the view of them to slow down, versus RBNZ suddenly turning a bit hawkish. So this is, like I said, the RV story. It's a bit, an isolated story. We had some nice moves in Norway versus Sweden. We see sort of big sell-off in oil in the last 1 or 2 weeks on the optimism on the story. But when we talk about the majors, when we talk about the actual dollar, the dollar index, then we are caught in a very, very narrow range. No one is willing to actually stick their head out. Yes, we know that ECB is going to hike in June. That's now more or less priced, because if you look at all the data with a single mandate, you just have no other choice. That they're going to repeat what they did in 2008 and hike while actually grow is at risk of getting slower. But in the meantime, we also have obviously repriced the Fed. So we've gone from Fed cuts to possible Fed hikes. So the whole story in foreign exchange doesn't actually change, because we've gone from, suddenly we expect hikes on both camps. We talk about BOJ hiking, but that's not the big story anymore as it used to be, because now we have the Fed possibly hiking as well. So these whole divergences have suddenly become convergences, or let's say less, direction moves on the margin. So that's why in the majors, you just got to stick to that day-to-day, week-for-week, near-term narratives. There's no way that you can really call that, because we don't actually know. Do we go back to war? I don't think so, but we could. Who knows? How long is Hormuz going to be closed? How long is there really going to be shortages into autumn, winter on energy in Europe? I don't think an ECB hike has to be seen necessarily as bullish for the euro, because it's about the least we can really afford. Not to talk about all the UK stuff, which is again an isolated stuff on sterling, not to do with macro. But on the macro side, hit and run. There is no other way right now than to sort of, there's some volatility with the news, right? So why do you want to try to read what Trump really thinks, really wants to do, and when he wants to do it? It's just impossible. So, I think more short term makes a lot more sense.
What is the phrase that I was taught and I traded? KISS. Keep it simple,
Yeah,
stupid.
Exactly. To be honest, there has never been a better time for KISS than right now, I would say.
No better time for KISS. And yeah, that seems to be the situation at the moment. We do have to look at what's out and how that affects the economy. And if we turn to sort of this week, the week ahead, again, ongoing, as you see from the clip, the ongoing face of war is one of them. Tomorrow we got Eurozone May flash HICP data on the wires. We've had regional states reports back end of last week. I've got a note here from Daiwa. It said that of the 4 main states who have reported May numbers, German inflation undershot expectations, thanks in part to a tax-driven drop in auto fuel, whilst inflation was up in France, Italy and Spain, on a bounce back in services. Like the consensus, we see headline HICP rising to 3.3% annually, up 0.3 of a percentage point from April's 31-month high. Estimates from the member states suggest that energy inflation remained the principal source of upward pressure, albeit in the instance led by a combination of base effects and household energy, after a relatively tame monthly change in auto fuel prices. Bank experts added that the core HICP rate likely rose back to its pre-war mark of 2.4% year over year from its 4.5-year low in April, due in part to normalization in package holidays and pressure in transport services. They end by saying core goods, however, appear to have fared better. Is it fair to say then that the war, if we hadn't had this war, we still be looking at a disinflationary environment for the Eurozone, and would hikes still even be a distant thought for the Eurozone? And to add to that, is a June hike a mistake in your opinion? the likelihood of it being reversed is, I don't think, small in terms of immaterial, I'd say, because this war could be, if things change, and we've seen these things change on a penny, and the situation changes and both sides decide, look, we don't really want a resumption of this, we want to get back to some form of normality, and they didn't have to reverse it. So I'm answering my own question really, but do you think it's a mistake, first and foremost, the ECB going ahead with a June hike if they choose to do so next week?
Yeah, personally, I think this is exactly the problem when you have a single mandate. Obviously, they do the right thing for the mandate, which is a single mandate of inflation. Now, the problem they had in the last 20, 30 years has always been the same, is the way oil prices or energy prices affect the Eurozone CPI. And you can just draw a chart, overlay it, and it's basically ECB policies about oil price and gas prices, which is, again, make you wonder whether you need a central bank in the first place or not, because a 5-year-old could do that. Now, the problem is, and that's why they're not going to take any chance, is what if while the war is not restarting, what happens if the status quo remains as it is? The oil tanker is going to get through. We have an overall shortage on energy. Prices will stay elevated. So the whole price pressure is there to stay. So then they can argue, well, it was the right thing to do. So I still think there are other means. If you, or let's put it this way, if you believe it's a short-term thing, which I think we all kind of do, because such a war is not going to last a few years. There are probably other means, and it's something I argued already during COVID, that fiscal policy and monetary policy majors have to cooperate better in a way that central banks don't have all the tools anymore in this modern world to actually address the real problem. You know, like we always arguing, a rate hike doesn't bring the oil price lower. I mean, it's just as simple as that. Are there other means how you can sort of, at least temporarily, which some countries have done, cut VAT on fuel, cut fuel tax, whatever, just to soften the blow a little bit for the consumer and for the inflation side? I'm well aware that, you know, the fiscal side is already a bit strained, so that cannot last forever. But if you think you have a 3, 4, 5 months window of this before it eases the pressure, then I think fiscal policy may have more to do than just simply ECB hiking rates. I think it's very stupid and very, it almost feels like clunky. You know, in the modern world today, it almost feels like monetary policy shouldn't be just like that.
But it is clunky, though, by the nature of the time it takes to affect and to work its magic. It's a clunky
that is
tool.
true. The only question is, does it have to work its magic if oil price would top out the moment this crisis is over? We talk about Warsh held a speech last week about whether he will be right or not. We shall see. He's like a his big ideas of this massive disinflation from AI and all this stuff, whether it happens or not, we don't know. So he's, despite that, we look at the US inflation data and you would argue, you know, it's definitely going the wrong way too. He's absolutely convinced that this is just a sort of a bump in the road, which, you know, I'm not that far of an expert to say whether it is or it isn't. But in the case of the ECB, they have to make that mistake time and time again just to be bailed out by the Fed. It was the same in 2008, maybe not as dramatic this time than it is. You can argue, does one hike really make a difference? It probably doesn't. So in that sense, it would be probably wrong to talk about a massive policy error. But if prices remain elevated and they indeed going to have 2, 3 hikes during 2026, then that's insane, right? One hike, okay, whatever.
Yeah, I mean, sorry, just to interrupt. So she speaking on the 30th of, at the end of April, she spoke on prices. One of the times she spoke, and she said energy prices are central to the inflation outlook, and constantly linked to the inflation outlook to the Middle East conflict and energy markets, saying that supply chain disruptions and a rise in inflation expectations could reinforce these price pressures. If energy prices were to rise by more and for longer than currently expected, euro area inflation would increase further. It's really all about expectations, though, isn't it? And second-round effects that should be their predominant fear, shouldn't it?
Yeah.
In terms of where they're at, and not purely the energy price, as you say, because central banks have never been able to pull down energy prices simply by
the
hiking rates.
Yeah, the ECB has the old problem, right? It has the Bundesbank problem. It has this kind of problem where it was initiated in 1999 as trying to copy the Bundesbank as closely as possible, because that creates this sort of trust into the central bank, and they just seem not to get away from the fact that they just remain. As soon as we have these sort of price development on energy, whatever, you get all the hawks out there, the Germans, the Belgians, the whatever else, core Europe, which is running that kind of 1930s kind of worried. And I'm not saying wrong or right, but it just, you have this old problem of the ECB being reminded, actually, you're a Bundesbank when it comes, when inflation starts to go up.
Yeah.
And so whenever there is these moments, they have never looked through such a moment. They always reacted the way they're gonna react now again, by hiking rates. Like I said, the only reason I can't call them fools is because if it suddenly turns out that in November we still talk about the same thing of Hormuz not really being open, like just semi-open, and all the problem, then no doubt, then the prices will continue to be elevated or going higher. So then I look like a fool, because I go like, I call them fools, but maybe they've done the right thing. But it doesn't do, we both know we're talking stagflation. That's what we talk about right now. The only thing which is interesting when we quickly flip back to the US, some of the data we see, which is so manufacturer, ISM, we're going to see service ISM on Wednesday. There is a feel, and I think we touched on that in one of our last chats about the dollar, that, until a few weeks ago, the market would have sold dollar aggressively when the war is over, go back to sell dollar because of Trump and all that stuff. That seems to have eased. It seems like the market is now looking again at the US exceptionalism a little bit, if that is the right word for it, where the data is holding in extremely well, while we can argue they have stagflationary trend data because of inflation going up. They don't have the same problem because their growth level comes from a much higher level. So I'm just worried that stagflation will be this next topic, and that's why I would have wished that Bank of England is going to look through what's happening right now, and the ECB should be looking through what's happening right now, and maybe just buy time for a month or two, because I think they could, but that's just my view.
Yes, interesting that you say. No, sorry, I didn't press the button. On the Iran situation, and I've got a piece on the board here that says Iran war inflation shock set to fall short of the 2022 surge. FT analysis shows that economists more optimistic now than 3 months after Russia's full-scale invasion of Ukraine. So, going by what you said, and just at present, it looks a little bit foolhardy potentially that ECB is going to that should hike, but like you say, we don't know what's going to happen down the road, and they're ensuring, I guess, that they can try and keep a lid as best they can on those second round effects on the Eurozone economies. So to try and be a bit balanced, like you say, that's their view. But again, it's really interesting. This FT article said in an FT review of forecasts collated by Consensus Economics, it shows that inflation projections have on average increased by 0.8 percentage points since Middle East conflict began in late February. This is far below the 2.3 percentage point rise in economists' forecast 3 months after Russia's full-scale invasion of Ukraine in 22, which triggered a race in Europe to secure alternative gas supplies. Downgrades to global economic growth projections have also, so far, been smaller than at a similar stage of the 2022 crisis, according to the analysis. So it's really interesting. Everyone's downplaying this for some reason, and seemingly thinking, maybe rightly or wrongly, that this is, like we talked about a little while ago, a short-term disruption, if anything, and will be right as rain.
Yeah,
in the next
to be honest,
and there's a little bit of complacency.
Yeah, I usually am on the side of complacency, but this I have to say, if you look at it, if you just, let's put it this way, let's just try to do a very brief review of the war. So what actually happened, as I think, is Trump thought that war lasts 2 days, right? 3 at most. at most, right? You kill the leader at the weekend, peace on Monday, boom, 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 Venezuela all over again. That obviously went wrong. Now we have other things that happen, right? So let's say Abu Dhabi or the UAE has exited OPEC. We know the US is drill, baby, drill. So once, and I think this is maybe where the idea is coming from. I could think, and that's why I'm also not on the, trying not to bet too much on the complacency, even though that would be my natural trading style. I think like you have Trump obviously doesn't want to have war again. He wants to open it. People gonna pump like crazy because there's a lot of money that got lost in the Middle East. There's like, everyone's gonna just produce up to the limit that he can, whatever the quotas are from OPEC. So I think the UAE step is the first step to maybe definitely, once the war is over, there's a race to the bottom of oil at some point. Yes, we know some stuff has to be brought back online and there's some delays here and there. And so that's why we're not going to have oil glued right away. But if you look a bit further out, you have to expect that, if you think the money that got lost from Saudi Arabia, Qatar, UAE now in these sort of few months of the war, the damage that's done to their reputation as whatever they try to build up, it's huge, right? That has to be paid one way or another. So that is the only reason why I'm actually on the sort of main theme of underplaying this maybe, or not betting on complacency. Politically, I'm nervous, as in complacency. I totally agree with you. I mean, they exchanging back and forth, exchanging a few missiles over the weekend, which is not your normal kind of stuff.
No.
So there is the risk. What always makes me a bit nervous on these situations is the accidental war, as in, the wrong missiles at the wrong place at the wrong time, creating all sorts of mess. And that is obviously the risk. If you have like the Gulf is full of American warships, missiles are flying up and down the Gulf, that is a worry. But
sorry, go on. You finish.
No. Over to you.
I was going to say, and I guess all of this is being cushioned by this AI phenomenon that we've got at the moment, and which is keeping the equity markets buoyant and very optimistic about the future. And I think maybe that is playing into the psyche a little bit. That against this backdrop of the oil crisis, you have this tech boom that's really promising to revolutionize the way we live and work and everything else that comes with that. And there's a lot of time and money, especially a lot of money being invested into the AI boom and getting that right, and the race to be the top provider of that. And so I think there is an element of that in mixing with all this as well. It's, it plays into the corporate world and all that sort of stuff.
Yeah.
Well, listen, I want to sort of move on to the big key point of this coming week, which is non-farm payroll. We have, just as a matter of course, we've got Australian GDP, Q1 GDP, but it's really backward looking stuff now, really. Now we're in the summer months. You've got US non-farm payrolls this week. Barclays reports here say we'll be closely watching the US labour market data for May. They forecast 75,000. I think the number is a bit higher. I think it's about 93,000 if I'm correct for non-farm payrolls, around that, 93, 95,000, down from 115,000 seen last month. But Barclays, with 73,000 for the headline and private non-farm payrolls, says alongside an unchanged unemployment rate of 4.3%, says barring revisions, this would place the 4-month moving average of payroll gains at 55,000, which we regard as the underlying pace. We'll also get JOLTS survey data, but we've got ADP on Wednesday, the private payroll report as well as initial job lists as usual. On the JOLTS, Barclays says that we think job openings remained relatively flat at 6.9 million from 6.866 million previously. So the labour market data in the US is one to watch. Again, you're trading this in the short term. How'd you get into the labour market? What would be an anomaly for you in order to maybe be inspired to press the button on Friday when the numbers?
That's a very good way how you put it. What motivates you to press the button on Friday afternoon after we sort of jiggle all week. No, to be honest, the sensitivity from payroll data has gone away a little bit since that sort of dip that we saw not so long ago didn't actually materialize. So when the Fed shifted to worry about the job market away from inflation, that obviously didn't prove to be correct. The job market seems to be all right. And so I think we would need to, I think we're talking about big misses or big beats where you may see a trade. I just cannot see, and I hate to sound so boring because I much rather talk about real macro stuff. But the reality is the market just goes from next data to next data, and the only real deciding fact is where do we? It's like today again, right? It's like one headline from Iran and everything's is on its head. So why do you want to really commit? You can have your view about the U.S. economy, about U.S. jobs, and in theory about whether the Fed is now starting to hike or not, and then everything falls apart by whatever the big, beautiful peace deal and all that stuff. So personally, I will just make a judgment call on the day. I see where the expectations are, I know where the market is, and then decide. But I would say for a quick trade, I would need to see a big miss. I want to see something below, 50K or 40K on the top. I would want to see something in the 130s before I would even think of pressing a button. And anything in a, 75 to 115 range, I probably don't bother, because there is nothing to bother in it's just ticking over the way we know it, which is actually solid job growth and no problem.
Interesting. Well, nicely rounded up. But thank you very much for your words today. Much appreciated.
Thanks for having me, Harry.
No, always a pleasure. We'll have we'll put a link up to where people can find you if they want a bit more of your insight into the markets and trading and so forth. Anyone who's missed the start of this episode, go back and listen to it on our social media platforms or on the podcast platforms out there, likes of Apple iTunes and Amazon Music and the like. So we're all over those as well. But thank you all for listening. Thank you to Pete again, and good luck trading this week. And we'll see you again for another episode soon.
Yeah. So, thank you very much, Harry. Have a lovely afternoon. Thank you. See you. Bye-bye.
Likewise. Bye.
LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.